Okay, perfect. So an angel is someone generally who is nice, by the way. These are the guys, the actual guys. These aren't just like someone who's related to the guy. These are usually the guys that work on it. And they want to give back and they want to help other people. The first thing you feel when you have a big exit is, oh, dude, I can help somebody else get here way faster than I did. Thank you, sir. And that's a good idea. Maybe. Nah, you're good. I just was stupid with my magnet. So an angel is generally going to be someone who's been there, done that, and usually they like to play in their own territory. So they have they're kind of specialized in that they want to work in their own space. So in other words, if I just sold an audio video company, I'm likely going to be really helpful to people who are in construction, services, technical stuff like control systems, security alarm systems, that kind of thing, right? And that's kind of where I might play as an angel investor. Other angels are generally pretty good at a lot of things. They may have been the operations partner of their business, and so they can jump into any business and help them with operations. And they're like, yeah, I'm comfortable investing money in anybody that I feel like could be a good operator with some good coaching. So that's where angel investors are a lot of fun. Generally, they are going to, how much and where does company need to be? Company revenue. Okay. So an angel investor is likely going to invest anywhere from $15,000 to $200,000. Okay, there's a K right there. So they're not going to give you $1 million as an angel investor. They're going to give you early seed funding. And so it's sometimes called pre-seed. Pre-seed and early stage funding is definitely what we're talking about today. And angel investors are going to likely be attracted to companies in their own space where they know they can help them. It's a good pet project for them. They're going to invest $15K to $200K. And then the company is either going to be zero revenue or maybe up to, I don't know, 2 million. So not a lot of revenue in this specific space, but they're going to come in their own space, invest 15 to 200K. And if you're more than 2 million in revenue, they're going to be like, I'm not really that interested because I don't know that I can help you as much as I could someone earlier stage. Does that make sense? But when an angel decides, you know what, I also want to go in on a big deal, they might invite some buddies or they might be part of a bigger fund. And that's when you get involved in what's called a VC or SPV and VC. That was weird how I spelled that backwards. I don't know why. Anyway, an SPV literally stands for special purpose vehicle.
What's an LP?
An LP means that they are a limited partner of that fund.
Okay.
So that's a great question. So if I had an exit for $100 million, I might take 10% of that money and choose to invest it on my own as an angel investor. If I was also playing the game right, I'd take like 25% of that and probably throw it in with a VC fund, like a group of other investors who exited, who are looking for later stage investment opportunities. So for example, a company might have 0 to 10 million in revenue, but we might invest together, 200K to 1.5 million. As a group, we would do that. And that would be a venture capital fund. Now, the problem with venture capital funds is that usually the who that's involved are people that have exited, which is good. But then also, you kind of get this group of MBAs who've never operated a company, who just look at the numbers and may not be as kind and caring as to how you're running the business. They're like, how come you didn't hit this revenue number? How come you didn't hit this? How come you didn't hit that? And they're kind of the more aggressive, like, people don't like VCs because they tend to be a little stricter than the, hey, I'm just running my business, man, give me a break type scenario. And so they like to get overly involved sometimes, or they get zero involved and say, you're not performing, we're going to take over the rest of your company, or we're going to buy your shares out of your company. And so they want to protect their investments, and so they will do what they need to do to make sure that that investment doesn't die as quickly. I should also put up here a failure rate. With angel investing, any idea how many investments from an angel investor are likely going to fail?
80%.
More. It's like 95%. So if 95% are going to fail, you got to be really careful, but you've also got to expect you're doing smaller chunks of change, and you can afford to lose some as long as there's 5 out of 100 that are going to perform really well, right? So if you're only investing in 40 companies in your portfolio, you got to have at least one that's going to work, right? So you got to spread your funds in a way that you feel, I'm really comfortable in this one, I'm not as comfortable with this one. If I'm really comfortable and I want to put more money into it, then they're going to form an SPV with their buddies, a special purpose vehicle. It's like its own LLC that they are personally going to manage together to run that investment. And these SPVs can be, honestly, they can be massive. They could be as low as 200K, but they might be as much as, 200 million or more. So SPVs are funny. I raised $90 million last year in an SPV for a real estate deal. It was the first time I'd used an SPV as a vehicle, but it was great. It was easy. All the partners knew that they were going to put their money in. They knew all the details of the investment, and they were like, yeah, I'm cool with this. I'll put in 30, you put in 50, I'll put in 10. And they just threw their money in, and it worked out really, really great. So SPVs are interesting. Usually, they're people that are investing in their own space. So real estate guys use these a lot because they're familiar with real estate. They know how it works. They know exactly what they're getting into, sometimes even more than the one raising the money. And sometimes that's why you can find really cool SPV guys who, if you're trying to raise money in a specific industry, you find these guys and say, hey, would you be willing to go in on an SPV with some guys, because this is a massive opportunity and I need a lot of money. I need probably $10 million for this, $20 million for this. You guys know exactly what you're doing. I'm a good operator. Come invest in me. That's what an SPV might look like. So lots of different flavors of SPVs, though. They're very interesting. So SPVs can be all over the board in terms of size. And I should also put on the side here, expected duration. How long do they want their money to be sitting with you? Because that's a huge factor in raising money. An angel investor, how long do you think they're okay with you sitting on their money? If you were to guess. 5 years? 3 to 5 years. Yeah, 3 to 5 years. These guys want their money back pretty quick. SPVs, they could last 10 years. VCs, they're also pretty short term. They're generally going to look for maybe 5 to 7, because they know that after them, there's a bigger shark in the water. And that bigger shark is private equity. Private equity is a whole different animal. If I had my investments, if I had my exit and I took a percentage of my revenue, I might put my biggest chunk of money into a private equity fund. Why? Because private equities are super safe. They're going after companies with like a minimum revenue of like minimum 50 million to whatever billion, right? And private equity groups have a very secure investment because they're not just investing in a startup. It's not in or close to a startup. These companies are proven, they're market leaders, or they're in the top 10 of their industry, but they want to become a market leader. And the private equity firm says, oh man, we know exactly how to take that business to make them the market leader because we've done this with 20 other companies in the last 5 years. So they go in and they buy up the company, and they're literally looking generally at 3 years. They feel like they can double the revenue in 3 years on a company that size and then sell it off to somebody else. And they do this over and over and over again. And some private equity firms are really, really specialized in certain industries, or they're specialized in very certain stages of business, manufacturing, stuff like that. Private equity firms are really, really fun sometimes because they know exactly what to do to get you from 50 million to 100 million or 150 million. And so as a business owner, you're like, dude, I'm stuck. I'm stuck at 50 million. I got stuck in a business at 10 million one time, and it was really hard to get past that 10 million mark. We finally did it, and then we realized it was way more headache after 10 million, so we scaled back to 7. We were way more profitable. It was way more fun at 7 million than it was at 13 million. And so we literally went backwards because the game was easier to play, and it was more. That's where service companies get more fun. Nothing wrong with a service company, but you got to understand that you're only going to be worth a certain amount of money. This is where valuation comes in. So when we talk about these different investor profiles, you need to understand who it is you're talking to and what it is that they're going to want. And angel, like we have an angel investment firm here called the Build Fund, and the Build Fund is fantastic. We invest in usually 15 to 100K, and we expect to see returns hopefully in 3 to 5 years. We've had several of the companies we've invested in have exited or sold or raised more money, and we got some of our return back already. Not many, but some. We're only 3 years into this incubator, and we've got some decent returns and decent growth out of some of our investments. Some of them have failed. Some of them will fail. We can see them on their downward spiral, and there's not much we can do to help them because of certain scenarios. So it's kind of sad. But we hope that with an incubator environment like this, our investments are going to have a much higher chance to succeed than just someone throwing money at them. Yeah. It's almost like an SPV. Yeah, it really is. And the fund here it's a $10 million fund, but it's primarily made up of like 13 LPs, meaning 13 different people threw in anywhere between 50 grand to $1 million each. And well, one of them threw in 5 million. Todd Peterson did. But so it's a heavy Todd Peterson fund, but he has very little to do with the decision making of it. But the fund itself is doing really, really well because we have a lot of companies actually seeing good success. And so that's kind of the profiles of these different investor types. And that's really something that's kind of voodoo magic. Like most people don't really know when they're going to raise money, who am I even talking to, right? And it helps to know who you're talking to because otherwise you get confused yourself. And you're like, okay, had I known any idea that this guy was actually had just sold a business in this industry, I would have approached him this way. Or if I knew this guy was an operations guy, I would have approached him this way. But when you pitch it the wrong way to a personality type that doesn't get you, that's the problem most people make when they're raising money. They don't know the fund. They don't know the people involved. They don't know who they're going to talk to. And so it makes it really hard to raise money when you're talking to someone who might be an MBA student who's never run a business, and you're thinking that they've exited a company. They don't get what you're talking about most of the time. So when you're talking to an MBA guy, you got to be all about your pro forma, know your numbers and all the other stuff, right? So there's a lot of know your audience here that is just as important when raising money as it is when you're selling your products. Does that make sense? So with now that we kind of know these profile types, let's talk about valuation, because valuation is another place where people screw up raising money. Valuation, anyway, can someone define to me what valuation is? Yeah. What is the value of your company, right? And so how do you come up with that number?
Cost of goods minus your price.
Okay, so you're talking about a net profit, or another word for that is EBITDA.
What does that stand for? Earning before interest, taxes.
Yep, distribution. Yeah. So EBITDA is basically, in a nutshell, it's your net profit before you pay interest and taxes. Because interest expense is just the cost of doing business. So a lot of people, they like to remove that out of the equation so they know what the actual, because if I'm going to go buy your business, I'm going to buy out all your debt that's 29% interest. You know what I mean? Because that's a heavy cost that a lot of small business owners carry. And so they're like, you know what? Taking that interest expense out of the equation and taking the tax payments out of the equation, how much net is the business actually running? That's what EBITDA is. So it's a friendlier number than net profit, because net profit takes out interest and it takes out taxes. That makes sense? So EBITDA is a friendlier number than net profit. Now,
Valuation and EBITDA go hand in hand a little bit. But
they go hand in hand because most of the time your valuation is a multiple of your EBITDA. So certain industries have higher valuation multiples. For example, a service industry is likely going to be a 1 to 3x multiple. Anyone have any idea what a typical SaaS company is?
like 5, 10.
It's actually, yeah, I mean, probably 6 to 8. I mean, right in there. What about what else?
I went through a warehouse last year. I tried to buy it.
A warehouse? Okay.
5x.
Like,
5.
was it a 3PL or what was it?
3PL.
Okay, so 3PL?
You wanted 5, but I was finding the industry average was 3.5.
Wow.
5.
So that's like a 3 to 5?
Yeah.
Any idea what defense is?
10.
14 to 18x. It's pretty nice. That's why I'm playing there.
I work for Sencor.
Did you really?
I do.
Oh, you do? Okay, perfect. What do you do for them?
Recruit the agents that we hire.
That's awesome. Okay, so what does this multiple actually mean? Let's throw some numbers out. So when you're trying to raise money, the company that you're raising from, or the group or the investor, is going to try to assess what your true worth actually is. When you're pre-revenue, it's really hard to say. Like, you're literally just guessing. Like, you're like, well, I've got this pro forma built out. I'm likely going to do $2 million at the end of year 2. That's like the most common thing I ever hear. Everyone raising money. 2 years, I should be doing like $2 million in revenue. So my valuation is going to be that minus their cost of goods sold. They're going to give me an EBITDA number, and then we're going to come up with a valuation based off their industry. Right? That's how it works. So when you're guessing, it's harder than when you're just showing actual revenue numbers. Because when you show actual revenue numbers, that's a lot more valuable to me than your guess of where your revenue is going to be in 2 years. You actually know where you're actually at, right? Because investing, that's why angels truly are angelic, because we're guessing that you're telling us the truth about what your real revenue potential is. You know what I mean? So this is all guesswork. This is a little bit more detailed because you're further along in your business development. And then this, they know exactly what they're looking at, and they're looking at every percentage point. They know exactly what your trends are. You've been in business for 10 years. They know what you're looking like and what you're going to look like in 3 years. Does that make sense? So private equity, VC, SPVs, angels, they all look at different things in a different way. Angels try to be very generous because I'm taking a huge risk, but I'm also going to get a larger percentage of your equity. Okay? So let's say I'm doing, let's say that, I don't know, should we grab one of your businesses? Shoot. Let's just take, I don't know. Frank, do you want to take your business?
Yeah.
Okay. All right. So let's just say, are you guys still pre-revenue? Okay. So we're guessing. What is your revenue you think is going to look like after year 2? Product is done in 9 months. You're selling. By the end of year 2, what do you think you guys are going to be at?
I believe we've got it down in 850,000.
Okay. Okay. So 850K. Now, that's a guess. That's an estimation. Likely. I don't think it's super bloated. I think you could probably get there. What is your net on that? What is your EBITDA going to look like? Okay. I'm just going to guess for you. Let's just say we're 30%, 40% profit margin on there. And you're going to come in at what about 400K profit. I would take that 400K and give you a valuation. Now you're kind of do you have subscription or you do have subscription? Okay. You have product and subscription. Okay. So product sales might be X, but your subscription model is where you get a higher multiple. So you're going to be somewhere in that 6 range. Let's just say 6. Equals a valuation of 2.4 million. Okay? So that would be your valuation of your company. So when you go out to raise money, you can say, well, look, by the end of year 2, we're likely going to be a valuation of $2.4 million because we'll have 850K of revenue and 400K in net profit. That's how you approach what your valuation is at that point. Now, what does that mean for me? What's that? I've just taken a low SaaS multiple because you have a regular recurring monthly revenue or annual revenue.
I'm trying to go into defense.
Yeah. Well, we'll play that game later. This is just an example. So, but if you were 18x, okay, what is 18 times 400? Oh boy. 0, 0, 2, carry the 3, 7. Is that 7? 7.2 million? Or is it 72? Ah, shoot. Somebody do that math. I'm not carrying my zeros right. So it's 7.2 or 72? Probably 7.2, right? Oh, come on. Why is my calculator not working? 7.2? Okay, we'll go with that. So if those are your valuations, and I invest, let's say you go and raise $300,000 that you need to raise money right now. I would, as an investor, expect that if you're $2.4 million valuation and I'm investing $300K, you now divide that number by that, and that gives me my equity piece. So 2.4 divided by 300K is how much? 1.2%. 12.5%. I just bought 12.5% of your company. But if your valuation was 7.2 million, do the same number for me. 7.2 divided by 300K. It's gonna be a lot less. Probably something like 4-ish. 3.8. So, from an investor's perspective, I really do care how much your company is worth. So we will beat you up as an angel investment fund, say, look, you're still pre-revenue. You're going to be more like 2.4 million in my mind versus 7.2 million valuation. Does that make sense?
Do you have to head out for a meeting?
I do.
Okay, I have an announcement I can make as you're packing up.
Oh, thank you. Okay, let me ask you any last questions about this.
This is great.
This is honestly, this is the foundations. Like when you look at what your multiple means, what your EBITDA means, now you start to understand what your company's actually worth if you are doing revenue. If you're not doing revenue, it's all guesswork, and you just get as much high of a valuation as you can. But when you can actually show revenue, that's where you start getting really serious with these guys about what your valuation is, why it's so important that you get a higher valuation, because you don't want to give up huge parts of your company for the same amount of money. That makes sense? So anyway, guys, I'll be back talking about this more.
Connections to angel investors.
Yes, we have tons of angel investors here.
And founders that are raising money.
And founders that are raising money.
All kinds of stuff.
Our fund is really, really fun to pitch to also because we kind of get you ready to raise with a lot of other people. Make sense? Okay, guys, I'm so sorry. I do need to run to a meeting.
You're good, Todd.
Okay, thank you.
See ya.
Appreciate you.
Yeah, don't forget your water bottle. Okay, do you guys know who Chris Kerner is?
Oh, yeah.
Okay, he's doing an event. Oh, actually, before I do that, look him up on YouTube if you get a chance. Yeah, Chris Kerner. Chris is spelled normal. Kerner is spelled Koerrn, and I think ER.
Say that again?
Koerner. So it's like this. Okay. So this guy, he's got 650,000-ish subscribers on YouTube, and he has he's holding an event where it'll basically be a more chill version of Shark Tank, and he's hosting it over here in the Boulevard. And so that's going to be on July 21st, and he posted about it on his LinkedIn. And there's 2 ways that you could participate. One, if you have a business that you want to be able to pitch in front of him, and I think they're giving out cash prizes and stuff like that. And then another option is if you want to attend and you want to watch. And so you can attend live, and it's like $30 a ticket, or $160 for like a VIP ticket where I think you get like a dinner with him and a couple other people. But it's going to be a super cool event. He's from Texas, so he's flying out over here to go do it. And he's got like a huge podcast, and he just is constantly talking about small business ideas and like cool opportunities that people can do. So anyways, the 21st.
Where do we sign up for this?
So if you go to his LinkedIn, it's like his 3rd to last post. And then we will have a slide up on the TVs where we'll have like links and stuff that you can like go sign up and like look at it and stuff too. So yeah, should be super cool. We'd love to get as many iHub businesses there as we can, and yeah, hopefully get some people attending as well. But yeah, super cool opportunity. But yeah, that's all for me. So
Awesome. Thank you.
yeah, no problem.
Thank you.